$1 trillion. That's how much Chinese capital was once tangled up in American companies, from Hollywood studios to Wall Street banks. But today, Beijing slammed the door shut. No warning, no wiggle room. And now, U.S. executives are scrambling to understand why the money pipeline just snapped. But this isn't just about a policy shift. This could be the first financial decapitation strike in a war that's gone from trade to tech to pure capital. And this could also mean layoffs, rising prices, or even a frozen 401k. So here's the question. Why did China just block all investments into U.S. companies? And what's Beijing really aiming for? Let's separate noise from signal. The decision wasn't emotional, it was strategic. China's Ministry of Commerce quietly updated its outbound investment protocols, classifying all non-essential capital flows to hostile jurisdictions as suspended effective immediately. The U.S. made the list. On March 17, 2025, China's State Administration of Foreign Exchange issued a directive halting all outbound investments into U.S.-based firms, citing heightened geopolitical risk and asset security concerns. The order wasn't announced. It was leaked buried in regulatory filings, confirmed days later by Reuters. Since 2018, Chinese investment in the U.S. has collapsed by over 95%, from $46 billion to just $2.3 billion, as according to Rhodium Group. This freeze pushes that number to zero. According to Professor Xiaodao Zhang at Peking University, the move is a calculated step to apply maximum capital pressure without provoking open retaliation. What's more alarming isn't what China just blocked, but what it's now redirecting that toward. And if you think this is a freeze, look closer. It might be the opening act of a financial siege. While trade remains active, Beijing has been peeling away from U.S. economic dependence piece by piece. In 2024, China sold off $104 billion in U.S. treasuries, its largest single-year reduction since 2016, bringing total holdings to $775 billion according to U.S. Treasury data. At the same time, Chinese state banks halted dollar-based transactions, with U.S. banks under new compliance rules issued by the People's Bank of China. U.S. Commerce Secretary Gina Raimondo warned in January that China is restructuring its financial exposure in a way that reduces our leverage dramatically. Washington's primary tools, export bans and tariffs, are proving too slow to match China's capital withdrawal, and new sanctions have pushed Beijing closer to Riyadh, Moscow, and even Brussels, where European firms are actively lobbying to bypass U.S. restrictions. The leverage gap isn't just growing, it may already be irreversible. But the next question hits closer to home. Foreign direct investment into the U.S. dropped by 22% in 2024, according to UNCTAD's latest report. And early 2025 projections show an additional 19% decline. Chinese capital was the most visibly missing, but not the only one. Norway's sovereign wealth fund recently divested $7.1 billion from U.S. tech stocks, citing regulatory unpredictability. Japan's GPIF, the world's largest pension fund, reduced its exposure to U.S. commercial real estate by 30% after Moody's downgraded several regional banks in February. With $4.1 trillion in U.S. corporate debt maturing by the end of 2026, according to S&P Global, and fewer foreign buyers to roll it over, companies are turning to domestic sources at higher costs. This isn't just a capital retreat. It's a slow tightening of the financial oxygen line, with pressure building fastest among mid-tier firms. But when they reach for rescue funds, what they're finding is even more alarming. With equity investment retreating and traditional bank loans constrained, American companies are issuing record levels of high-yield debt. Over $430 billion in junk bonds were floated in 2024, a 38% increase from the year prior, according to Bloomberg. Average yields have climbed to 9.6%, up from 5.2% in 2022. One real-world case. Boston-based manufacturing firm Hartwell Tech saw a $180 million Chinese-backed equity round vanish overnight due to the investment freeze. The firm turned to Apollo Global for emergency bridge financing at 11.3% interest secured against IP assets and property. Fitch Ratings now warns that 1 in 5 U.S. mid-cap firms faces acute rollover risk within the next 18 months. With private credit funds extracting tougher terms, many businesses are being pushed into financial arrangements that prioritize survival over sustainability. But wasn't America supposed to have insulated itself from all of this by reshoring? Donald Trump's 2025 executive order expanded tax credits for reshoring, aiming to rebuild critical supply chains domestically. Yet, the National Association of Manufacturers reports that 62% of firms planning U.S.-based expansion now face funding gaps, largely due to missing foreign partners. Projects announced in 2023 with partial Chinese or Taiwanese financing, like the $8 billion battery plant in Michigan or the $3.1 billion robotics hub in Nevada, have either been delayed or canceled outright. Even the CHIPS Act's success is being diluted. Intel's $20 billion Ohio project, meant to showcase America's semiconductor independence, recently paused Phase 2 construction as funding delays mounted. Economist Eswar Prasad told Bloomberg in February, "Without diversified capital, these initiatives risk becoming symbolic rather than transformative. As supply chains localize, costs rise, and the reshoring dream may be colliding with the brutal math of capital scarcity. But the real test will come when consumers start paying the price for policies they barely understand." U.S. import tariffs under Trump's 2025 expansion now affect over $500 billion in Chinese goods, up from $370 billion in 2020, with average rates hitting 22%, according to the Peterson Institute. As a result, consumer electronics, home appliances, and auto parts have surged in cost. Appliance prices alone rose 16.7% year over year by Q1 2025, based on data from the Bureau of Labor Statistics. Walmart and Target have issued margin warnings in back-to-back quarters, citing direct tariff exposure as a top-line threat. The National Retail Federation now estimates an average household will pay $1,950 more in goods by year-end. Corporate profits are narrowing faster than analysts expected. Q4 2024 saw S&P 500 profit growth at just 1.2%, down from 4.5% in Q3. WSJ reported forcing companies to either absorb the cost or pass it along. But with real wages stagnating and inflation sticking above 3.6%, passing it along could crater demand and take balance sheets with it. Yet compared to what's next, these cost pressures might feel like a warm-up. According to the Economic Policy Uncertainty Index developed by Baker Bloom and Davis, the first quarter of 2025 uncertainty in the U.S. is at its highest point in over a decade, surpassing both the 2020 lockdown period and the 2008 financial crisis. Contributing factors include simultaneous monetary tightening, volatile fiscal policy, and unpredictable trade sanctions, all converging during a fragile global recovery. The Conference Board's CEO Confidence Index plummeted to 37 in March, its lowest since mid-2020, with 68% of executives citing lack of policy clarity as a barrier to forward planning. Bank of America analysts wrote in February that capital formation is stagnating not because of cost, but because of confusion. Investors have begun fleeing risk. Over 120 billion exited U.S. equity ETFs in just the last 90 days, Bloomberg data shows. What's emerging isn't a temporary dislocation. It's a long-term question of trust. And if start recalibrating that trust, Washington may not be the one setting the rules much longer. Germany's BASF doubled down on its $10 billion expansion in China in February 2025, days after Chancellor Merz's visit to Beijing concluded with a joint energy technology agreement. Meanwhile, French Minister for the Economy Bruno Le Maire finalized a new long-term LNG settlement denominated in yuan, bypassing dollar clearing entirely. The European Chamber of Commerce in China reported a 19% increase in European capital deployed in mainland industrial zones in the first quarter of 2025 alone, citing policy consistency as the primary factor. Even Saudi Arabia is diversifying away from U.S. treasuries, allocating $27 billion toward a joint AI development fund with China and Singapore. Former IMF chief economist Kenneth Rogoff told the Financial Times, U.S. soft power isn't collapsing, but it's losing gravitational pull. Allies aren't defecting in protest. They're diversifying to hedge against American volatility. And Beijing, rather than demanding allegiance, is simply offering predictability. But behind that predictability is a much deeper game, and it might already be underway. Beijing's investment freeze isn't just defensive, it's potentially phase one of a coordinated capital redirection strategy aimed at starving U.S. markets while inflating its own regional ecosystem. The China Securities Regulatory Commission confirmed in March that it will fast-track foreign IPO listings in Shanghai and Shenzhen. With 38 new listings in the first quarter alone, a 52% increase from the previous quarter per Caixin Global. Simultaneously, China's sovereign wealth fund quietly increased its exposure to ASEAN debt markets by $19.4 billion according to a leaked HSBC report reviewed by Reuters. The most strategic move, however, may be the digital yuan now integrated into SwiftLite settlement networks in 13 countries, allowing for cross-border deals without touching the dollar. HSBC analyst Harold Wang notes, it's not about replacing the dollar overnight. It's about building enough alternatives that the dollar becomes just one option, not the default. With U.S. financial credibility wobbling, the drain may not come through confrontation, but through gravity. And the next time Wall Street looks up, it may find the money already moved. So if Beijing can quietly bleed American markets by starving capital, rerouting liquidity, and rewriting the rules of global finance, what happens when it goes for the next domino? Because this investment freeze may be just the first signal flare. The real question is, what if China convinces even U.S. allies to stop settling trade in dollars? That would reshape the global system, not with sanctions or speeches, but with math. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.